Okay, straight on to our next session. I'm going to ask Jeremy, I'll get the panel to come up as we did the last time, all in one go. It's a bit quicker. So if I could ask Bettel, Marco, Richard and Clarissa to join Jeremy, who's going to facilitate this particular panel on international growth. Thanks.
So one thing I was wondering was what music I'd have, and so Justin Timberlake, I think, so pretty good, showing my age. I know all these things. So what I wanted to do was to just, I'm going to introduce the panel in a moment, but just to take a couple of points that John has just mentioned. You know, from Commercial Finance Association's perspective, one of the challenges that we have as an organisation is just to really understand how big our market opportunity is. In the US, they've just commissioned a very extensive report on sizing the market, and it's something that we really want to do here. Our target market is those mid-market businesses upwards, and our target member is a lot of banks, because a lot of banks do varying size of transactions, and indeed the smaller independent financiers that make up our market. So, you know, a lot of commonality, and it's all about growth of our market, or the market. A couple of trends that I just wanted to mention. We're going to talk about this in more detail in a minute, but non-recourse factoring, non-recourse financing, receivables purchase is where I think a lot of the growth is coming. In my time at Bank of America and my time at Lloyd's, it's pretty obvious that these larger companies, what they want is outsourcing of their basically their receivables, and they want it off balance sheet so that they don't hit covenants, and a lot of these large LBOs, that's what the FDs are seeking. So there remains a big opportunity for us to do this, and to John's point, why can't we penetrate the market more? It mystifies me. I think for the last 15 years, I just can't understand why. From a regulatory perspective, it makes so much sense to do asset-based factoring, well, whatever type of financing we call it. Why we can't get that growth? And I think it's down to the clients and talking to their banks and just accepting that that's the best solution for them, and the banks going an easier route. So Kevin, this is something for you to really think about. Your extraction product is a great product, and I think that is the future of making it easier for the clients. If we can say to the clients, well, here's a tool, this will make it a lot easier for you, because they want to outsource everything. So that is the future, and this will be the growth of, so in 5 years' time when we come and talk again, we would have seen this growth, hopefully. Anyway, right, that's enough of me talking. Just made some notes there. I didn't really come prepared to talk about that. But so I'm president of Commercial Finance Association in Europe. It's a chapter. It's non-profit. The whole idea is it's a collaboration. I love that word, collaboration, collective, working together, and we want to work with all of you and HPD and others and all the people here to just kind of promote our industry. Data is I think where we should be seeing a lot of growth. So without further ado, what I'd like to do is ask each of the panel. As you can see, we have a diverse panel. So I've ticked that D&I box. So which is so I'd like to just if you start from the end, please, if you'd introduce yourself and just give an overview of what you do within Tradewin.
Okay. Well, my name is Clarissa. I've only recently joined the world of trade finance. I actually come from global trading, from commodity trading to be precise. Within Tradewin, I work in the commercial department, obviously, to seek new opportunities for what has been defined as large clients. In the area of commodities and surrounding industries. Tradewin is an intelligent finance company working globally. We have about 20 offices, operating in 20 countries, covering 4 continents. Well, this is what Tradewind does. I think I'll pass it on.
Richard.
Yes, good afternoon, everybody. I'm Richard Olver. I'm the head of invoice finance for the commercial finance unit at Siemens Financial Services. And we are effectively the captive finance provider for the Siemens Industrial Group across the globe. And our job is to effectively facilitate, as Siemens moves more from product sales to solution-based sales, is our role is to assist in that process for both our clients and suppliers and the partners within the Siemens and the Siemens domains.
Okay, thank you. Okay.
Hello, my name is Marco. I work in the EBRD's trade facilitation program. Multilateral bank, headquartered here in London. For those of you who might not be so familiar with what we do, we invest in Eastern Europe, CIS countries, and over the last couple of years, we also added a couple of more countries around the Mediterranean countries, which was decided on a political level for us to also invest in those countries. As a bank, we obviously engage in various product types, from infrastructure to agribusiness, financial institutions. But I personally represent FI business, and within the FI business, we have a program which is called the Trade Finance Program, Trade Facilitation Program, where we provide classical trade finance limits for our partner banks from Eastern Europe all the way to Mongolia and around the Mediterranean countries, including, for example, Egypt, Morocco, Tunisia, Jordan, just to name a few. And on top of this, we also try, and I say try because we're still in the process of building up factoring business in many of our countries of operation. And I'm happy to give you a little bit more insight later on when we discuss these points of what we exactly do and what kind of problems we face in the industry on the emerging market side in our countries.
Thanks. Betul.
Okay. I would like to first of all thank you to all HPD team for inviting us together today here. My name is Betül Kurtuluş. I am Regional Director of FCI, responsible from Central Eastern Europe, Southeastern Europe, including Turkey and all Middle East. And I am not new in the receivable finance industry. I have been in this industry since 1990s, and I was responsible from the factoring company in Turkey, and also I was in the leasing business. Now I am serving for FCI since the beginning of this year.
Okay, thank you very much. As you say, we've got a very broad cross section of people. So I've got these questions. The way I'd like to do it is the questions are quite different. So please feel free to add something that's relevant in the midst of it, rather than waiting for a Q&A at the end. So first question is, it's a bit talking about the global marketplace. I think the big difference to probably 15, 20 years ago is that we've got a global economy nowadays. Supply chains are global. They're not single country. However, there is something going on in the political climate with a move to bilateralism. And really, I'd just like your take on where do you think this will go in the future? You know, Trump is trying to, effectively, there's a trade war potentially with both Europe. I think 25% is going to be added as a tariff for German cars imported into the US shortly. So there'll be some form of tit for tat following that. And then obviously we've had steel tariffs. So what do you think the future might hold, and how does that affect the clients that we work with? So I'm going to ask Richard first, because you're the company, you work for a German headquartered business.
Yeah, and Siemens is a global platform. I think a lot of the challenges is when we do that, we have a very large and separate supply chain finance agreement with Orbion, actually. It's one of the largest supply chain finance programs in the world, runs into billions. And when we discuss that and how we can leverage off of that, the need for the product irrespective of the tariffs, is still the need for the product.
You're still going to need it.
It's not going to change. It might evolve in how it's going to be used. We've recently done the first of our distributed ledger and blockchain events, and Siemens has invested heavily in that in healthcare and other supply chain areas. So I think it's evolving. The need won't change. What it's going to do is maybe the values that flow through it will change. But right now, even when we've had those strategic discussions about do we need to evolve, do we need to change around it, for now it's a watching brief. It really is a watching brief, because if we can keep the supply chain, and on the customer need, we're seeing a greater need for customers not wanting to buy, as we say, equipment. They wanted to buy solutions. So we're seeing the emergence of new elements around whether they be discounted future cash flows, pay for use, that sort of model. So that's where our evolution is. The regulatory elements are coming into it, but in terms of the bilateralism, the supply chains are still going to be where they are. I mean, if you take like the Silk Road initiative out of China, this is a huge investment, and Germany, much to the chagrin of the US, as we know, have invested heavily in this. And again, the supply chains in and out of China, John shared the numbers, the growth in China alone is going to be on a par with the rest of the globe. So right now, watching brief. The need will remain, the need will evolve, and that's exactly where we are.
Maybe slight change structure, maybe products will go through other countries first or something. So
yeah, I mean, we do coordinate them, but we use different vehicles in different legal entities. But generally, as we know, the supply chain is mainly via SPVs, but the other elements, we use the appropriate entities that we've got.
Marco, what about from
Well,
your perspective?
Obviously, working for a multilateral bank, the name itself has it already, makes bilateral agreements for us very difficult. And obviously, we as a multilateral institution, we see the headwinds coming towards us in terms of, particularly from certain states or governments who see the need potentially for multilateral banks, not as they were maybe a couple of years ago. I would, of course, strongly counteract to these kind of comments, because we obviously see the work which we do in various countries from a different perspective. But coming to trade finance, I mean, us being in the industry, and particularly myself, who's not domestically focused but very internationally focused, we see, of course, the incredible benefits which we have without trade barriers, and the damage which can be done if trade barriers being brought up, and the disruption to the supply chain. I mean, in working for a bank, or what we do in the program, we're not really engaged in the underlying transaction, and of course the real pain will be with the respective importers and exporters, and the local banks dealing then with these barriers which have to be, or which will potentially be implemented, and of course the customs and so on and so forth. So we will see how this will trigger down. But I just returned from China 2 weeks ago, and the Chinese market is feeling the impact they have with regards to the tax they have to pay and the customs. And there are certain areas, and I talked to a couple of exporters in China as well, and they said that their business volumes are significantly down. So if this happens really also in Europe, potentially our volumes will also be significantly down, and this remains to be seen how this then filters through to our industry. I assume this will also have an impact on the factoring industry, particularly those of us who are involved in the international factoring side, not only domestically. Having said this, of course, the supply chain is also heavily domestically focused. So personally, I see it very critical, but politics is involved in it, so will remain. It remains to be seen. Yeah.
Yes. Yeah. But all from your side, because you're looking at obviously various factoring and other members of FCI in your location.
Well, I would like to talk about some more the business environment generally. It is changing, because it is very competitive in every part of the world. And the productivity is very important to stay in the business. On the product, profitability is very important. So when we look at the different countries, to increase productivity, especially the corporates, the SMEs or the small, medium-sized companies, they need to increase their product, all part of their business. So, of course, the production side is not our maybe subject today, but the funding side is very important. And they really need sustainable program like supply chain finance programs, kind of things. It's very important, especially for the emerging markets, because in the emerging markets, especially small, medium size, also with the big corporates, they're very open the development, the bad side of the economic crisis, the fluctuations of the currencies, and some domestic problems, maybe difficulties in exporting, kind of things. So sustainable finance solutions is very important. The supply chain is the payable finance side. It's one of the solutions for increase the productivity. But it is, we are all talking about here, there's some kind of solutions on the supply chain. We have a product, supply chain finance solution, which name is FCI Reverse. So it is a very good solution for the suppliers in the emerging countries. But the important thing for me is the difference. What is the value added of FCI? We have a local presence, because when we launch a new product, it's like a payable finance or any kind of supply chain solutions, it is very difficult to launch the product in the emerging markets, to understand the product, to accept something new in their system. So what is our value added for the increase the productivity of the clients? We have local presence. It's an FCI. We have 400 members in 90 countries. So if a system needs a local presence, FCI provides very strong local presence to launch the product, to understand the local needs of the corporates. This part is very important, because otherwise it is difficult.
So, okay, well, we're going to move slightly towards, actually it's a very general question here. Now this is kind of obvious, but to a lot of people. What are the barriers to funding against export debt, and how can they be mitigated? Now, so let's just concentrate on Europe and maybe emerging markets as well. So if you're an exporter from here, what are the issues that you face? So I'm going to ask, first of all, Clarissa on that question.
Oh, I knew you'd ask me. Well, export funding towards emerging markets, problems you'll be facing are, well, the general issues like quality claims, non-delivery, and with these jurisdictions or markets, it's, in most of the cases, a matter of not really knowing what's going on. So mitigating these risks, there are various ways. From a commercial perspective, it's a matter of really diving deep into the various industries, really understanding the workings of them by, well, taking it the hard way by going through the sales contract, purchase contracts, understanding, well, the quality issues on load port analysis, those type of things. But that really requires to look into it very deep, into each and every industry. Exactly, really understanding it and well, trying to mitigate these risks by making everyone within the company understand what the focus needs to be, where they need to be very alert.
Because some companies, I'm guessing, would they just want the export, they want the sale. But you as a lender or financier, so what about insurance? What about credit insurance?
Well, credit insurance, of course, is because for Tradewind, it's a matter of non-recourse factoring only. So insurance is a must. It's a given for each and every debtor. But as everyone knows, it doesn't cover like 100%.
Yeah.
So to be on the safe side, you better be prepared for what might happen, which is, like I initially said, basically quality claims, non-delivery, or those type of things.
What about Siemens? from the blue chip perspective?
I mean, again, our clients are, and so if we're selling cross-border, so a lot of Siemens manufacturers in factories is servicing the whole of the globe, so that supply goes everywhere. But generally, I would go back to, again, reiterate what Clarissa said, is do the basics that you would do anyway. So good survey, good understanding of the client, how long the tenure, what's the history of that sale. We also use other vehicles like insurance and the like. But generally, we have one advantage in the captive, is we have an understanding of the underlying relationship. So we would do, say, one of the products we do is an extended payment term product, but we know that Siemens has dealt with that client for a period of time, and it gives us an advantage because we can get to that trading history, and we have what we call a credit database that we can use for that. But on a client that is, say, a Siemens partner and we're funding their debtors, we do all the old-fashioned things. We look at survey, we look at the debt, we go and look at what deliveries they've got, what insurance, if nothing else, and we set limits. We set concentration limits, we set export limits, and it's nothing really sexy. We just do those things right.
Yeah.
Okay. Marco, again, some of the countries you might be involved with would be countries we would really struggle with. So.
Exactly. So I find it very interesting to hear from the commercial side what kind of checks they do in order to be able to export, because our underlying transactions, sometimes they include, of course, also Siemens products, for just as an example. I mean, that's probably what we are really there for. We take off the risk of these very exotic trades, because the countries we operate in are not just Romania and Bulgaria, which are usually acceptable risks, for example, in Eastern Europe or Central Eastern Europe, but also we support trade, for example, to Tajikistan, Kyrgyzstan, Mongolia, some of the Middle Eastern countries where the appetite is just not there in order to be able to secure these kind of deals. And I think we are not, for example, as large as an export credit agency, which can do hundreds of millions. So we are more on the smaller size scale, meaning our trades which we cover are really from a couple of thousand up to 25 million euros. But I think interesting to mention, of course, is even though we work in these very challenging markets, and we've done more than 20,000 transactions, we've only had 2 claims so far. And this was only related to a bank in Kazakhstan and a bank in Ukraine during the financial crisis of 2008 and 2009, which just underlines also the statistics which we have, that trade finance or the trade finance product as such is a very safe product. Having said this, of course, I'm sure lots of exporters have delays in payments, they're not being paid. And then, of course, you need the security from a bank in order to be able to get to your funds. But there are ways out there, in order to mitigate the risk. And even if you're in the most difficult markets, there are ways to support these kind of trades.
Betul, what do you think?
Yeah, I totally agree with Marco, and the receivable finance is the best solution for exporters to mitigate the risk and the barriers. But it is, for me, the crucial question is there enough understanding or awareness about this product in between the corporates? Because usually, especially in the emerging markets, they're not aware of the opportunities for the receivable finance products. The receivable finance is a generic term, so we have some different kind of asset-based lending, factoring, or invoices kind of different products. But usually, what I see from my personal experience, that the corporates they are simply not aware of these products. For example, factoring is very, very useful product for the emerging markets, especially for the corporates coming from the emerging markets, because we are securing the receivables, and we are providing finance for those secured receivables, which is usually very supported prices, because normally when you secure the receivables in the countries from the developed markets, you can finance your receivables in the emerging markets with those countries the secured receivables financing rates, so which is very competitive. For example, in Turkey, if you have a secured receivables from Germany, from Spain, or from UK, you can reach a very supportive finance rates, and also with the collection of members. So it is very easy for the corporates if they do not have any knowledge of the language, kind of things. But the problem is they are not aware of this product.
Awareness again.
Awareness is very low. Yeah.
Okay. So talking about this question for you two really at this end, in terms of no-go areas, you know, you're expanding definitely to countries that I would find uncomfortable in looking at. So are there any countries that you've tried and just felt, well, no, it's just they're just so far behind, or the law just doesn't give us any comfort whatsoever?
So no, but because by our mandate we have to invest, and we get clear instructions from our shareholder. Okay, 500 million have to be invested. So we just have to be very careful in what kind of projects and product we invest. And of course, we are in a position to cherry pick, which doesn't mean that sometimes the investment volumes are easy to pick. But if I may talk a little bit, particularly about the factoring and trade finance and these kind of products, and I just have to reiterate what Betül said, is the markets where we operate, and I'm always incredibly impressed when I attend a conference like this, because usually I attend conferences in our countries of operation, that the knowledge, know-how, what is in this room is not available, let's say, somewhere in Central Asia. I don't want to pinpoint any specific countries, but I just, for example, returned from Mongolia, also 2 weeks ago, which are combined, obviously, with my trip to China. But these markets, they're very interested, they're hungry for information, they want to do, for example, factoring, but they don't know how to do it. And they see everything from a distance, and although we try to explain them through technical assistance, we have cooperations, for example, with the central bank, with the regulators, it takes time and it takes years to filter down that kind of information. We're by far not there where we want our counterparties and our markets to be. So if you look at our countries where we operate, really from Central Eastern Europe, which is a very developed market, and then we move further east, and it gets less and less. And this kind of knowledge transfer, even though there are reliable counterparties, is incredibly difficult for us. That's why, for example, we also team up with FCI, of course, and we also cooperate, and some of the HPD colleagues, they know, because they attended some of our conferences. For example, last year we did one in Georgia, in Tbilisi, or the year before in Vienna, where we invite our counterparties from our banks, and they have an incredible interest, for example, in supply chain finance and into factoring. They know how to do the basic trade finance, but they're not getting to the step in order to be able to do the more sophisticated products. So they all know they have to do something, but they're just not able to do it. So this is then our aim, or our task, of course, to get them to this level. But then, of course, you face the problem with the regulators. You face the problem with there's no proper ledger system. So you really start from probably where the market has been here, and by all means, I'm not an expert, but in terms of the real factoring business in Western Europe. But to me, it looks like it is 20, or sometimes even 30 years behind what, for example, Turkey does, what, for example, the UK does. And it takes an incredible long amount of time to get the countries to that level, to our counterparties to that level, for them to have a sophistication level where they can really say, okay, we do supply chain finance, we do proper factoring. They think probably, it can be done on an easy Excel file, and we just offer it, and we cover it up as supply chain finance and factoring, but there's so much more behind. And this is, it's fascinating for me, of course, to see, and we try to help them, but it's a challenge, I would say, yeah.
However, what these countries can take advantage of is that they can look at countries that are developed and have probably developed over time and gone through various hurdles and mistakes and different routes. They can just effectively go take the best ideas.
Absolutely, and I think one of the countries, particularly in the emerging markets where we are operating, is what they look at is what is being done in Turkey. So Turkey is the role model for
Yeah,
a lot
it
of
is.
the Arab countries. Of course, because it's the proximity and the liberal approach how to do business, but also the Caucasus region, Central Asia, they all look towards Turkey. It's not necessarily Greece, which also has a developed factoring market, but it is the Turkish
because
model.
the law is in Turkey. We have a very strong law. It has been approved by the parliament in 2012. And yeah, I agree. Of course, Marco. It's in the emerging markets, the regulator, the government representatives, they are very keen on just establishing these factoring products, and they are very supportive also because it is very supportive product for their export. So they want to increase their, of course, they want to support their export. They want to help their corporates. But it is, they're very supportive, but it doesn't mean that it is easy. It's simply very, very time consuming. And yeah, Turkey is a very good example. So we have a very, very strong law. It's approved by the parliament, and it has been supported and developed by the bylaws since 2012. But still, from the first factoring operation till the law, it has been 30 years in Turkey also, so it is not easy. It is very time-consuming something, but still, as I see from the emerging markets, they are very, very supportive. They are trying to launch the strong law for the receivable finance, and we, as an FCI, we are just organizing some kind of promotional, educational conferences jointly with the EBRD, and we have some other partners, for example, in Africa. We're working with Afreximbank, we're working with the World Bank, and we're working with the ICC. We have many partners, but still it is, they're very supportive, but it is not means that it's easy. It's very difficult.
A bit like moving an elephant, I get a feeling.
Yeah, it is.
So I think we have 5 minutes. Yeah. So any questions at this stage? I've got. Yes, Kevin. Just talk loud.
Yeah, my question actually it's actually to Richard and Clarissa, because you've actually both got businesses. So you've both got businesses operating in different jurisdictions. And I just wondered, that must be quite interesting, and what you see then from a bird's eye point of view, what the differences are, about how different countries operate, and what the ups and downs are of that.
Well, this is what actually makes Tradewind, having those offices and having local people working there. It's a matter of language, it's a matter of on-the-ground support. Each and every country is different, but then again, each and every client is different. And the majority of clients actually need this, well, let's call it supply chain covering various countries. And this is basically where we focus on. For example, one of the leading Brazilian food exporters exports from Brazil into inventory financing support from our side in UAE, and then exporting into MENA countries. And this complete picture is something we cover, which, works well on revenues, naturally, but also helps to mitigate risk at the same time, which means we can really span like a big umbrella across countries with various jurisdictions, because we have these offices operating in those countries. Well, basically all around the globe.
I think when we started and we had a look at the footprint, the demand is there, but it goes back to a little bit of what John said earlier. It's down to due diligence. It is old-fashioned business plan building.
Yeah.
What's the addressable market? Can we get the Siemens relevance out of it? Can we make the returns? Can we compete with the local providers? Our clients are not so much that low end of SME, it is that mid-market, larger corporates. Are the covenants with their banks going to allow them to move, especially to a non-bank funder? That is a major problem we find. Very protectionist sort of actions in certain jurisdictions. We've done due diligence in 5 countries in the last 3 years where we have not hung up a shingle, and deliberately. We've taken very, very niche specific approaches to what we're going to do, because we've got the same as the banks, we've got capital returns, shareholders, etc. And honestly, it is old-fashioned business plans. What's the market, what's the product, and then it's that localization. We think global, but you act local, because that nuance in that regulator, that tax, that stuff, if you get it wrong, and as you well know, we had some joys with various regulators, and you do need to know that local point. So it is think global, have that point. There is a very set criteria which I adhere to, and as some people may be aware, when they don't make the criteria, I shut it, and I have done that already. So it's old-fashioned. It's, does it make a return? Does it tick the box for the shareholder? And does it tick the box for the customer? If it doesn't, find another way to do it. And we're doing a lot of partnering as well at the moment. We're looking for, if we can't do it, there are some very good people, and some of those people are in this room, who can do it.
Time for one more if there's another one out there.
Go on,
Back there.
It's just a general question, really, because, I mean, I was just thinking back to the earlier presentation on Brexit and the fact that people are retrenching, thinking of tariffs. And I guess what's happening, and I'm seeing it on data, is that people are stocking up. People are holding on to more stock. Inventory days are going out. And then at the same time, as a sub-question to that, is if we're always doing the same things because we're worried about returns, we're worried about, you know, the shareholder views, how are we going to change the industry? Because we're all comfortable doing the things that are safe. So hence we come back to the 40,000 in the UK, we come back to the same things we were talking about 10 years ago. And it's not easy, but you know, it's the SME that I feel for, because I think there's so much choice for the large buyers. So I guess my question is, how much of your business models are focused on SME versus large corporate?
I'll start with help you out, Steve, a little bit, because in the UK it's much more that business is there, and we've got a very proud statistic. Probably about 22% of our client base is new to invoice finance. Why? Well, we didn't have any legacy when we set up. We set up as a greenfield. And we went and asked clients what was stopping them dealing with stuff. So we've used technology a lot. Our client manager to client ratio is probably better than most, because we didn't have any hiccup. But we started with, we asked what the pain was. So while we've got our Siemens customers, we've also got, for scale and profitability, we have a third-party presence. So we have addressed some of those changes using technology and the products, but we use invoice finance as a headline. Like I say, we do for people who want to buy from Siemens electronically, we will do almost a single invoice factoring. So if they want extended payment terms, we'll do that, like pseudo inventory. Yep. And we're seeing more in the distribution markets, not the direct sales markets. We're seeing more and more need for inventory style products, but we're getting to them via receivable transaction building. So we are innovating in order to do it, but we're using the knowledge we have that we use as our competitive edge of knowing those underlying transactions within Siemens. So when you haven't got that legacy, sometimes it's easier. And there are some really funky, technology pieces that you can put together. And that point, as we work with HPD, they also work very actively with the partners that we work with.
Thanks, Richard. And Clarissa, just quickly, from your point of view, how much of your business would be, large buyer related versus SME?
Well, surprisingly, we just did a survey a couple of weeks ago for our internal knowledge, and about 80% of our clients are from the SME business. And only about 20%, if even, are large
That's great.
clients.
Excellent.
But then again, as you've seen on various sheets, where does all the revenue come from? From the large clients. So this is where, from our perspective, not generally speaking, the focus should be, but those type of industries providing these large clients, they should be looked at, and a company like Tradewind should educate itself on those type of industries to be able to take it up with these type of large clients, because those are very specific industries.
Okay. Thank you very much to Jeremy and all the panel. Thank you. Very time for coffee, everyone. If I could ask you to be back in your seats for 4 p.m. prompt, please, for our next speaker. Thank you.